What if the biggest story in the gold market isn't the price, but something happening quietly behind the scenes? What if July 24 isn't just another date on the calendar, but the beginning of a financial shift that most investors won't recognize until it's already too late? While headlines focus on daily price swings, central banks are making moves, China's gold strategy is changing, and the behavior of the dollar, oil, and global markets is raising questions that few are asking. Could this really be the hidden bullish message everyone is overlooking? Or is the market preparing investors for something far bigger than a simple gold rally? Stay with us, because by the end of this video, the answer may completely change how you look at the future of gold and the global financial system. Welcome to Next Alert, where we break down the world's biggest economic stories into clear, practical insights you can actually use. If you're someone who believes it's better to prepare early than regret later, take a moment to subscribe and become a part of our growing community. Every week, we bring carefully researched updates designed to help long-term investors stay one step ahead. And before we begin, we'd love to know, where are you watching us from today? Let us know in the comments below. Your city or country is always interesting to see, and we enjoy hearing from viewers around the world. For years, investors have relied on a simple principle. When uncertainty rises, markets respond in predictable ways. Gold climbs as investors seek safety. Oil surges when geopolitical tensions threaten global supply. The US dollar strengthens if interest rates are expected to rise. Stock markets become cautious as borrowing costs increase. These relationships have guided investment decisions through financial crises, wars, and economic recessions. Yet today, those familiar patterns appear to be breaking down. Gold continues to hold surprisingly firm despite expectations that interest rates could remain higher for longer. Silver, after experiencing sharp volatility, refuses to collapse below key support levels. Oil prices remain far calmer than many analysts expected, despite growing instability across the Middle East. Meanwhile, American stock markets continue hovering near record highs, even as borrowing costs remain elevated and consumers face increasing financial pressure. Each of these developments, viewed individually, may seem understandable. Together, however, they create a picture that is difficult to ignore. History shows that markets rarely send conflicting signals without an underlying reason. When several major asset classes begin behaving differently from historical patterns at the same time, experienced investors pay close attention. They understand that markets often reveal changes long before governments, economists, or financial headlines fully explain them. This is precisely why a growing number of analysts have shifted their attention toward an unusual date that has recently become the center of discussion within the precious metals community, July 24th. At first glance, the date appears ordinary, yet across investment circles, reports and speculation have continued to circulate regarding changes taking place inside China's gold market. Some believe these developments could strengthen physical gold demand for years to come. Others argue the market has misunderstood the situation entirely, and that expectations have become dangerously exaggerated. The debate is only intensified as one remarkable figure continues to spread across financial media. A theoretical gold valuation of $38,000 per ounce. For many investors, such a number sounds impossible. For others, it represents evidence that the global monetary system may be approaching a fundamental transition. The truth, however, cannot be found by focusing on headlines alone. Every major financial shift begins long before the majority of investors recognize it. During the years leading up to the 2008 financial crisis, stock markets continued reaching impressive highs, while serious weaknesses quietly expanded beneath the surface. Banks appeared stable. Credit markets appeared healthy. Consumer confidence remained relatively strong. Only later did the world discover how much stress had already accumulated within the financial system. That historical lesson remains relevant today. The purpose of this discussion is not to predict an immediate financial collapse or guarantee an explosive rally in precious metals. Instead, it is to examine whether today's markets are once again presenting a calm surface, while deeper structural forces continue developing underneath. China's evolving role in global gold markets, changing central bank behavior, shifting monetary policies, and unusual movements across currencies and commodities may all represent separate events, or they may be pieces of a much larger puzzle that investors have yet to fully assemble. Before accepting bold predictions or dismissing them outright, it becomes essential to understand why these unusual market signals are appearing simultaneously. Only then can the real significance of July 24th be evaluated, separating genuine structural change from speculation and identifying whether the market is quietly preparing for a much larger transformation than most investors currently expect. Imagine waking up to discover that one of the world's largest economies has quietly begun changing the rules of its gold market. Not with dramatic announcements or emergency press conferences, but through policy decisions that receive little attention outside financial circles. Most people would never notice. Professional investors, however, rarely ignore quiet policy changes. They understand that history is filled with moments when governments signaled their long-term intentions long before markets reacted. Sometimes those signals appear through interest rate decisions, sometimes through central bank purchases, and sometimes through subtle changes in the way a country allows its citizens to buy, sell, or hold strategic assets. That is exactly why China has become the center of one of the most important debates in today's precious metals market. For decades, the global financial system has largely revolved around one currency, the US dollar. International trade, foreign reserves, and commodity pricing have all depended heavily on its stability. But over the last several years, China has been quietly building an alternative strategy. Rather than making bold public declarations, Beijing has consistently increased its official gold reserves, encouraged domestic production, expanded international trade partnerships outside the traditional dollar system, and gradually strengthened its influence within the global precious metals market. None of these developments happened overnight. Each move appeared relatively small on its own. Yet, when viewed together, they suggest a country preparing for a financial future that may look very different from the one investors have known for decades. This brings the discussion to the issue that has captured so much attention: China's changes to paper gold trading. To many retail investors, the phrase paper gold sounds technical or even confusing. In reality, the concept is relatively simple. Paper gold allows investors to gain exposure to the price of gold without actually taking physical possession of the metal. Instead of owning gold bars or coins, they own contracts or financial products whose value follows the price of gold. Physical gold works differently. It cannot be created with a computer entry or expanded through leverage. Every ounce must be mined, refined, transported, stored, and secured. Because of these physical limitations, many long-term investors view physical ownership as fundamentally different from paper exposure. This distinction is at the heart of the current debate. Recent announcements involving several major Chinese banks have led many commentators to claim that China is banning paper gold altogether. Others argue that this interpretation is misleading. The reality appears far more nuanced. The reported changes primarily affect certain leveraged gold products offered to retail customers through major banks. Investors still retain other avenues for gaining exposure to gold, including physical ownership and other investment vehicles. That difference matters. If the market misunderstands what is actually changing, expectations can quickly move far ahead of reality. And when expectations outrun facts, volatility often follows. This uncertainty is also fueling one of the most extraordinary claims circulating across financial media: the idea that China's long-term strategy could eventually justify a gold price of $38,000 per ounce. But before accepting or dismissing such projections, one critical question must be answered. Is China truly reshaping the foundations of the global gold market? Or are investors allowing speculation to race ahead of the evidence? That question may ultimately determine whether July 24th becomes just another forgotten market date, or the beginning of a much larger monetary story still unfolding. Financial markets have a habit of creating two completely different stories from the same event. One group sees opportunity, another sees danger. Both study the same charts, read the same reports, and follow the same headlines, yet they arrive at entirely opposite conclusions. The difference is rarely the information itself. It is the interpretation. China's July 24th market changes have become a perfect example of this divide. To one side, these developments represent the beginning of a powerful new chapter for precious metals. They argue that reducing reliance on leveraged paper trading could gradually shift more investors toward physical gold and silver. If that happens, while central banks continue accumulating reserves, the supply of available physical metal could become increasingly tight over time. To them, today's uncertainty is not a warning sign. It is the foundation of tomorrow's bull market. The other side reaches a very different conclusion. They believe investors have become too optimistic too quickly. They argue that changes affecting paper gold products could temporarily reduce speculative demand, encourage profit-taking, and place additional pressure on prices before any long-term benefits emerge. From this perspective, excitement surrounding July 24th has created expectations that reality may struggle to satisfy. So who is right? The answer may depend on a factor that has nothing to do with China at all. Because while investors continue debating gold, another institution still holds enormous influence over every financial market on the planet: the Federal Reserve. Its decisions on interest rates, inflation, liquidity, and monetary policy have the power to reshape capital flows worldwide. Even the strongest long-term trend in precious metals can be delayed, accelerated, or completely transformed by changes in monetary policy. This means China's strategy cannot be analyzed in isolation. It exists inside a much larger financial system where central banks, bond markets, currencies, and geopolitical events constantly interact with one another. And that larger system may hold the real answer investors are searching for. There's an old saying on Wall Street: the biggest opportunities rarely announce themselves. They develop quietly, often dismissed as unimportant until the evidence becomes impossible to ignore. That may be exactly what investors are witnessing today. For weeks, financial headlines have been dominated by one question. Will July 24th send gold soaring, or will it trigger another correction? But that may be the wrong question entirely. Professional investors rarely focus on a single date. They focus on direction, because history shows that transformational changes rarely happen overnight. Instead, they unfold through a series of small developments that gradually reshape the financial landscape. Looking back, those developments seem obvious. Living through them, however, they often appear disconnected. China's recent actions may fall into that category. Whether July 24th produces an immediate reaction or not, the broader trend deserves far more attention than the calendar itself. Over the past several years, China has steadily increased its official gold reserves, encouraged greater physical ownership, expanded trade relationships outside the traditional dollar system, and strengthened its position within the global precious metals market. Viewed separately, each decision appears manageable. Viewed together, they suggest a country preparing for a financial future where hard assets play a much larger strategic role. That is the hidden message many investors may be overlooking. The real story may not be about chasing a sudden price spike. It may be about recognizing that governments around the world are gradually adjusting to a monetary system becoming more fragmented, more competitive, and less dependent on a single reserve currency. This does not automatically guarantee dramatically higher gold prices tomorrow. Markets rarely move in straight lines. There will continue to be corrections, periods of disappointment, unexpected policy decisions, and headlines capable of shaking investor confidence. Short-term volatility remains part of every long-term cycle. However, experienced investors understand that structural trends matter far more than daily price movements. That is why the smartest market participants continue monitoring several key indicators rather than reacting emotionally to every headline. They watch central bank gold purchases. They monitor physical demand instead of focusing exclusively on futures markets. They study capital flows into and out of precious metals investment products. They follow movements in the US dollar, treasury yields, inflation expectations, and Federal Reserve policy. Most importantly, they pay attention to whether governments are changing their long-term behavior, not just their short-term rhetoric. These indicators often reveal far more than daily market commentary. As for the widely discussed $38,000 gold target, it should be viewed with caution. It represents a theoretical calculation based on specific economic assumptions, not a confirmed forecast or an inevitable destination. Financial history is filled with impressive projections that never materialized exactly as expected. The lesson is not to believe every extraordinary prediction. The lesson is to understand why such predictions emerge in the first place. Sometimes they are driven by speculation. Sometimes they reflect genuine structural changes beginning to take shape. Distinguishing between those two possibilities is what separates disciplined investors from emotional ones. And perhaps that is the most valuable takeaway from this entire discussion. July 24th may not become the day gold suddenly changes forever, but it may become another important milestone in a much longer story, one in which central banks continue accumulating hard assets, nations gradually diversify away from traditional financial systems, and investors begin reassessing the role of gold in an increasingly uncertain global economy. Whether that transition unfolds over months or years remains impossible to predict with certainty. What can be said with confidence is this: markets often whisper before they shout. Those who learn to recognize the whispers are usually better prepared when the world finally hears the noise. Thank you for watching Next Alert. If you found this analysis valuable, consider subscribing for more research-driven insights into gold, silver, global markets, and the economic forces shaping tomorrow's financial world. And now we'd like to hear from you.